McGee Wolf with the Wolf Group, back again with another great video designed to help you make great decisions in home ownership. This video is definitely for you or your clients if you own a home and you make additional monthly debt payments. I'm going to show you the power of restructuring that debt in a way that will have an enormous impact on your finances. What you're about to watch has the potential to have a huge impact on your finances. If you capture the main concept of how to leverage the equity in your home and focus on what is most important. Everyone fixates on the interest rate of their mortgage, and I get it. Of course, the interest rate is very important. But let me show you why it may not be what is most important to you. I have a tool that calculates all these numbers, so if you want an analysis on your personal situation, reach out to me. The assumptions are you purchased your home for $250,000 in January of 2015. Based on typical appreciation, your home is likely worth a little over $310,000. You put 20% down when you purchased it and had an initial loan amount of $200,000 for 30 years. Your interest rate of 4.5% is fixed for 30 years. You have a principal and interest payment of $1,013, and now 5 years later, you owe $182,644 on your mortgage. So when you subtract that from the value of your $310,000 home, you have about $127,000 in equity. And let's assume you have a car payment and a handful of credit cards totaling $54,000 with monthly payments totaling $1,633. Now remember, this is just an example, but this is where the magic happens, so watch carefully. We consolidate your debts into your mortgage and free up a significant amount of cash flow in your finances. There is no sleight of hand here, it's just simple math for a computer. What I'm proposing to you is you refinance your current mortgage for an amount that's sufficient to pay off the current mortgage balance, the vehicle, and the balances on the credit cards. Your new mortgage is also a 30-year fixed with the same interest rate of 4.5% and closing costs of $4,000. The loan amount necessary to put this together is $240,644, which leaves equity of almost $75,000 remaining in your home. Let's take a look at how this changes how much you pay for debt each month. Your mortgage payment has increased by $136, but you are no longer paying the vehicle note and paying all that high interest on the credit cards. But your overall savings on your monthly debt payments is $1,427. That's right, $1,427. In my experience, getting a raise of $1,427 a month or $17,000 a year would make a huge difference in most people's lives. What should you do with that available cash? You can do a number of smart things depending on your priorities, like save for a college education or start an investment account with a professional money manager. Here is what will happen if you take that improved cash flow and apply it to your new mortgage payment. This is going to shock you. You would pay your house off in a little more than 9 years. That will save you $144,000 in interest. You heard that right, $144,000. Remember earlier when I said everyone fixates on interest rates? Well, let's assume that we apply a ridiculous interest rate of 5.5% to this new mortgage and see what happens. You would have to make your mortgage payment for an additional 6 months, save only $1,280 per month, and only save $139,836 in interest. If your loan officer hasn't gone over any options like these, well then you're riding the wrong horse. You should switch to a winner. Call me. They don't call me the loan surgeon for nothing. If you thought this was helpful, please hit the subscribe button below and share it with anyone you know. You can comment or ask a question below, or you can contact me directly. Our goal is to deliver great content to you or your clients, and hopefully you learn something. And we also want you to have a smooth mortgage experience. Everyone here at the Wolf Group joins me in thanking you for sharing a few minutes with us, and you have a great day.